Managing Director of the Finance Brokers Association of Australia. Just explain who your members are, if you would, first of all, Peter.
Yeah, sure. Thanks for having us in, Steve. Our members are financial mortgage brokers who are representing right across the country, who are the ones who are out there writing these home loans, and they can be car loans and commercial loans as well. But they're doing the work on behalf of the lender, what we call the origination, and they're the ones out there who are speaking to the borrowers direct.
You mentioned, or you heard Peter Ryan talk about, the talk is from some of the bank studies that 1 in 8 people have exaggerated, let's say, their income. Do your members see evidence of this? Can you pick this up at all? Your members pick that up at all when they say, I don't think your figures add up?
Yeah, look, we actually do. And the challenge is that a lot of our members are the ones who are actually saying, sorry, we can't help you. There is a point in time to say, sorry, it doesn't work out. What we find is what we call channel conflict. They wind up going elsewhere, realise where the loopholes might be, and then take some angles to get their loan approved. Right. But most of it we've seen so far doesn't come through the broker channel. But look, it's a risk. It's a conversation, so you're hoping people are telling you the truth.
Now, so what's your members' feeling about this year? A whole lot of those people on the fixed rate mortgages will be coming off those fixed rate mortgages, and they will then have to start paying round about that 5% interest rate level. What's your take on that this year?
Yeah, it's a real concern. So we were looking at the data last year, and the bell curve shows that this peaks in July of this year. So you've got your run up and fall down. You've got around that 800,000 mortgage holders that are going to be impacted by this, or mortgages that will be impacted by this. It's really problematic because these people have gone into this with a 1 or a 2 at the beginning of their interest rate. They're going to come out. I mean, even at the moment, the average fixed rate has jumped to 6%, 6.07%. And don't know if that completely affects everything that's going on in the marketplace. So they're going to be paying a really big jump in their repayments. We've been educating our members to talk to borrowers and say, look, start preparing for this, even though not knowing exactly where we would land. But, if you're on a 2% interest rate, work out your payments on 5.5, put the difference away somewhere and get used to not having the money so that when this day eventually comes, you'll be much better prepared for it.
Are people calling finance brokers now saying, look, I'd like to try and do a refinancing arrangement or go to a different bank or make some adjustment? Are they calling? Are they picking up the phone and speaking?
They are, most certainly. This is a time where things get extremely busy and the phones for the brokers are ringing, and they're also taking the proactive step as well to reach out to their clients and say, hey, are you doing okay, or do we need to talk about what your situation looks like?
And what are you hearing? What do they tell you? Do they tell you? They say, I'm really worried, I'm doing it tough, am I going to lose my house, Peter White?
Well, fortunately, I'm not a broker these days, so they don't come to me direct. But look, they are coming back to people and saying, look, this is a problem. How do I navigate this? What is the best outcome for me in what I'm doing? Because it is a very personal decision. We all look at the interest rate and think it's the be-all and end-all, and it is an enormously important part of the conversation. But it's also a matter about, should you take a fixed rate or not, and what impacts those decisions?
My guest is Peter White. Peter White's the Managing Director of the Finance Brokers Association of Australia. So refinancing, I assume, is the most attractive option, or is it?
Not necessarily. So when it comes to looking at your situation, so this isn't really working for me, and I don't think it is when I jump off, first thing you need to do is talk to your existing lender. Have a chat to them and see what you can negotiate. And they're up to negotiate. Sometimes they might get a little bloody-minded on you, but there are options there. There are cash-back incentives that they give to people to come to them. But we've got stories of people that are existing clients said, well, you're prepared to give them $5,000. What about me? And I want a better deal. So you need to take that approach first. And if that doesn't work out, then you've got to look at your market options.
All right. We heard Peter Ryan there mention that an online bank, or a bank that has an online option, is now looking at mortgages, extending them from 30-year mortgage to 35-year mortgage. What would be the reality? What would be the impact of that be, Peter? What does that mean?
Yeah, I'd have to take a leaf out of Peter Ryan's book there. I think that's a very nervous step. Extending your mortgage by another 5 years is going to put an enormous amount of additional repayments you're going to pay, which means you're going to pay more interest to the lender. It does lower your repayment. So in some cases, it probably makes sense. But again, look at the bigger picture when you're doing this and saying, how much actually am I going to pay over 35 years now? And depending on how old you are, you may be well and truly retired before you meet that maturity date. So you've got to plan these things out.
We're almost getting to Japan-type structures then, aren't we, where the debt of a loan is passed on from one generation to the next generation. I don't want to be alarmist about it, but it's heading towards that a bit, isn't it?
It certainly feels that way. I can't say I'm a supporter of it, but
yes.
But as we go forward, we've got to look at new options. It's got to be more innovative. I think one of the big things that actually happens in the US, you can actually get a 30-year fixed rate. Now, maybe we need to be looking at those things. It is backed by the government funding arms that are sitting in the US, so it is different to us here. But we need that kind of innovation to say, look, how do we protect ourselves from that?
Peter White is my guest from the Finance Brokers Association of Australia. What's the average home loan size right now? What's the dollar amount?
It's just a whisper over 600,000, and just before Christmas it was 610. So it has come back a little bit, but I'm surprised I'm not seeing more. But when you look at the unemployment rate is still going down, people's wages and spending habits are still up there. People are able to afford what they're paying in their lifestyle. So these are some of the inflationary measures that become a little bit problematic as we go forward.
Now, the latest Westpac bulletin that sort of tracks home loans that are written up indicates that here in Brisbane or Queensland, home loans, the number of home loans that have been written up has actually dropped just under 5%, but 4.9%. Can you speak to that at all? What does that indicate to you?
To me, it's an expected trend. People are looking at trying to do something and finding that because of the servicing rate, so that little bit the banks put on the top to protect you from interest rate rises, which is around 3% above the rate. So now if you're talking an interest rate of 6%, that means your servicing is going to be based on 9%. Now that has a whole lot of traps involved in it at the same time. But what it means is that people can't necessarily afford to do what they want to do, plan to do, or would like to do.
Let me ask you about how credit cards factor into this, because a lot of people have loans where a credit card is sort of attached to the mortgage. I had a bank no longer with them, but they had a very nice, healthy credit card, and I thought after a while I went, no, I'm getting rid of that. And I assume, I don't know how much credit card rates are attached to the cash rate. The credit card rates seem to be stratospheric.
Yeah, they seem to be, and they tend to play out that way. When we look at the movement of the cash rate over time, credit cards are still sitting around that 20%, maybe a little bit under, a little bit over, depending on what card you've got. So they don't necessarily get directly impacted by it, but the indirect impact is if you can't afford your mortgage, what are you going to pay first, your mortgage or your credit card? So there's some hard decisions. Yeah.
Peter, thanks for coming in.
Thank you very much. Appreciate it.
Peter White is Managing Director of the Finance Brokers Association of Australia.